Quite frankly, it reminds me of the e-commerce or e-retail industry in 1999 when Amazon had to build all these technologies for their own company, and then they turned around and made them available for others.
So SoFi is in the middle of building their secret weapon that they call the AWS, or Amazon Web Services, of fintech, which could disrupt a $1 trillion industry and be the reason SoFi either ADXs in price or falls flat in its goals for the future. Because right now, SoFi is in the middle of a raging debate in the investing space. Are they burning investor money on high stock-based compensation and faking growth by acquiring smaller companies? Or are they aggressively investing in growing their business as quickly as possible, foregoing temporary profits like Amazon did in 1999? So this video is going to answer that question by looking at SoFi's most important weapon that it has for the future, their technology platform. I'm going to break down the platform and its impact on the company in 3 ways: its earnings impact, its technical advantages, and its strategic impact. Going through each category individually to see if SoFi is actually making smart investments or are they wasting investor money, which is really our money, and seeing if SoFi's stock price will collapse completely or if it's about to hit an S-curve of exponential growth. So hit the like button if you want, and let's start with a quick overview of what SoFi's technology platform even is. SoFi was founded in 2011 by 4 co-founders, including Mike Cagney, who was the CEO at the time. SoFi started out purely as a student loan company, offering loans to graduate students across the US. But they soon branched out into all aspects of personal finance, from offering home mortgages to a credit card to their SoFi Invest app to their Galileo payments processing. They even recently became one of the first fintech companies to obtain a banking license. Take that, Robinhood. But early on, the company faced difficulties with their culture, and Mike Cagney was eventually forced out of the company amid harassment claims and complaints of a toxic work environment. After he was pushed out, SoFi brought on veteran businessman Anthony Noto. His resume included stints as the chief operating officer of Twitter, a managing director at Goldman Sachs, and the CFO of the NFL. And with Noto, the company matured, expanding into its 3 main businesses today, going public via a SPAC led by Chamath Palihapitiya, and acquiring several smaller fintech companies. Today, SoFi really has 3 businesses in one: their legacy lending business, their financial services, which includes the SoFi app and services like SoFi Invest, and lastly, their technology platform, which I believe is the most important part of SoFi's business for its future. It's like the smart kid on your group project in school who just does the whole project and says it'll be done, but you have no idea if he's actually started, so you start to worry, and then at the last minute he whips out something amazing and you all get an A. Okay, that one may have been too specific. But technology platform is exactly what it sounds like. SoFi's own custom-built technology that can do everything from process payments to power checking accounts to maybe one day settling stock trades. It's taking all the outdated infrastructure that runs the finance sector and bringing it into the 21st century. Sounds good on the surface, but there's also a lot of controversy on how SoFi is growing this segment and whether it could even potentially bankrupt SoFi before they can reach a sustainable scale. So let's now dive into those 3 areas of impact that the tech platform will have on SoFi's business, starting with earnings. Now, SoFi's technology platform does make money for SoFi, but that's certainly not its primary purpose today, which when I say that out loud, that sounds a little strange for a company. But last year, this segment generated $194 million in revenue, which is more than double what they made the year before. But that's still only about 1/4 of the revenue SoFi pulled in from its lending business segment. So this isn't contributing that much to SoFi's overall earnings. Plus, there's the very controversial issue of stock-based compensation, which a few people called out fairly in the comments on my last video. And for many, this is the crux of whether or not SoFi can ever succeed as a business or if their goals are too expensive for them to achieve. So to take a step back, stock-based compensation is where you give employees stocks rather than cash for their performance, and it usually goes to highly paid individuals like engineers or business managers. What is interesting though is stock-based compensation doesn't always show up as a cost for the business, since it doesn't actually take any money from SoFi to issue those new shares. Instead, that money comes from diluting the shares of everyone else holding the stock, basically you and me, which is fine at low levels, every company does this, but it can be a problem if the company is basically using their shareholders as a giant piggy bank to fund their flawed business model. So what we need to figure out is that the case here? Well, let's start by looking at how high SoFi's stock-based compensation actually is, which we can see from this really nice chart here. The most important metric here is stock-based compensation as a percentage of revenue, measured in this blue line here. So we can see that even as SoFi's revenue has grown rapidly, stock-based compensation is growing even faster, with the last couple quarters topping 25%. Now let's be clear, that is a high number. Compared to other businesses in the credit services industry, that puts SoFi in a league of its own, with many companies paying less than 1% of their revenue in stock despite similar growth levels. Even Upstart, which similar to SoFi has a strong focus on technology, is only paying around 8% of their revenue as stock compensation. And if we look at the 67 technology companies in the S&P 500 7 years ago, 12% of pre-tax profits for these companies were equity-related incentives, which is still far below SoFi's current numbers. So based on that metric, SoFi's stock issuance seems to be out of control. But my first question when looking at these numbers is, why is everyone catching on to this issue now, with dozens of articles and videos coming out in the past few months addressing this issue? After all, we can look at the chart and clearly see that aside from Q3 2020 when they had a spike in revenue, their stock-based compensation has always been high. Well, I think there's two answers to that. Number one, SoFi presents their earnings using a non-GAAP accounting standard and only files GAAP numbers with the SEC. Non-GAAP accounting often does a better job of describing how a business is actually doing, but they can also be more easily manipulated than GAAP accounting. So if we look at slide 19 of their latest earnings presentation, we can see how they reconcile their non-GAAP numbers with their GAAP numbers. And the biggest difference listed is stock-based expense at $239 million for 2021. But number two, stock-based compensation as a percentage of revenue might not be the right number for determining if they're spending too much here. I pulled those earlier charts from a Seeking Alpha article by Business Quant, and the article is actually pretty good overall. But I think the key point we're missing is how stock-based compensation is actually paid. There's a reason that non-GAAP accounting generally excludes stock from expenses, because in a cash flow sense, it's not taking money out of the business. It instead takes value from the market cap itself. It's kind of like having a kid, where for the first 9 months they absorb all your nutrients and you hope to get a return on your investment once they graduate college and build $1 billion business. Now, up until recently, SoFi has had a market cap of $12 billion to as high as $20 billion on the high end, with it just recently dropping down to around $6.5 billion. So if we look at SoFi's stock-based compensation when the stock price was high, it didn't have a big impact on the stock price at the time. Even $50 million in stock 2 quarters ago only amounted to maybe 1% of SoFi's market cap per year. That would be $200 million in stock-based compensation per year into a $20 billion market cap. That kind of dilution isn't super noticeable, especially when the price is trending up. But look at it now when we're on track to have $340 million in stock-based compensation, diluting just a $6.5 billion market cap. We're looking at SoFi giving away 5% of our value every year as compensation. That's enough to start making a measurable difference on the dilution of the stock. So if SoFi stays at its current market cap while spending the kind of money on stock-based compensation that it is, that seems excessive to me. Now, if the market cap increases substantially, that may be less of an issue, because I do think SoFi needs to be willing to spend to attract the best technical and managerial talent, especially with their aggressive expansion through acquisitions like Galileo and Technisys. It takes a strong management team to form all that into a cohesive company. So for the category of earnings, I think technology platform is having a negative effect on SoFi in the short term. It's expensive to run, revenue isn't really increasing, and there's no substantial profit coming out of this compared to, say, lending, which is very different from Amazon Web Services, which has been a profit powerhouse of Amazon for years. But let's now see if SoFi's technology platform can make up for it in the next two categories of technical advantages and strategic impact. After all, Amazon did lose money for most of its life before emerging as the colossus that it is today. Maybe SoFi will be the same. But in the category of technical advantages, SoFi shows a lot more favorably. Now, there's really 3 parts to SoFi's technology plan. Step 1, build a massive payments processor kind of like PayPal. Step 2, build a core banking system on the cloud. And step 3, become the digital bank that other banks use. Now, while they've had this plan for a while, SoFi has managed to run through all of these steps in a matter of less than 2 years. But let's not get ahead of ourselves, and let me actually explain why they're taking this strategy in the first place. So step 1, build a payments processor. SoFi skipped this step by acquiring the Galileo Technology Platform in 2022 for a lot of money. But with that money, they've bought themselves the ability to process the payments of Galileo's over 100 million active accounts. Galileo offers an API, or application programming interface, where just using relatively simple pieces of code, different companies, banks, startups can use their APIs to process their payments. Some of the use cases for this are issuing virtual cards or enabling digital banking. They offer these services to all kinds of companies who want to use their platform, from small, low-cost startups to multi-billion-dollar businesses. This is useful because it lets SoFi control the customer interaction at the point of transaction, both for themselves as well as for the competitors. Then step 2, build a core banking system. Again, SoFi bought their way into this space by acquiring Technisys for $1.1 billion in, you guessed it, stock. So investors are very much funding SoFi's growth here. Now, I did see some people implying that these acquisitions were just made to artificially boost SoFi's revenues numbers, but I don't think that Noto is that short-sighted. For each of these purchases, SoFi spent the equivalent of 10% of its market cap at the time, and they've only gotten $200 million in revenue to show for it up until now. If they really wanted to prop up their numbers, they could spend in the lending space and get a much better return on that, at least in the short term. But more important than their revenue is Technisys' technology. Essentially, other banks and fintech companies use Technisys as the technological backbone for their own offerings, which is why the company boasts 100 million banking customers across 16 countries, even though they themselves don't make that much money. They're like the guy in the basketball game who passes LeBron James the ball for LeBron to make the dunk. And then step 3 is to act as the bank for other fintech companies. SoFi obtained a bank charter at the start of this year, accelerated by their acquisition of Golden Pacific Bank. This gives them the right to act as their own bank rather than partnering with an existing bank, which is what companies like Robinhood are forced to do. And when you put these 3 steps together, you get magic. Hopefully. While a traditional bank runs on ancient machines running in a back office somewhere that only processes stuff overnight, hence the 3 to 5 business days it takes you to do anything, Technisys operates more like a modern technology company where other banks can use their services in little modular pieces as needed, and they can scale up as quickly as they need to as well. SoFi is obviously building their strategy toward providing cloud-based financial services, and they've been doing it for a while. And Technisys is really the leap forward that SoFi's been needing. So when SoFi says they want to be the AWS of fintech, they mean they want to run the fintech world on top of SoFi-owned machines, using SoFi-owned software and generating data and customers for SoFi. So for technology advantages, SoFi is risking it all by absolutely throwing money into acquisitions to become the leader in this space. It won't be easy and it won't be cheap, but I absolutely believe SoFi's investments in this space give it a positive technical advantage over its competitors. Which leads us into the last category of what is the strategic impact of SoFi's technology platform on both the company and the industry as a whole. Well, we already mentioned the technical strategy. If SoFi can build or do a mix of acquiring and building a technology backbone for financial services, it can provide that backbone to other companies, even direct competitors. Just look at Netflix and Amazon. Both compete for content, with Prime Video and Netflix both looking to gain more subscribers than the other, and yet Netflix runs most of their business on top of Amazon Web Services. Similarly, there are thousands, maybe even millions of startups who use Amazon's cloud infrastructure to launch new, innovative digital companies on a daily basis, because it's just so easy to do nowadays. Heck, even Kylie Jenner's lipstick company ran on top of AWS. Imagine if starting a fintech was that easy. No complicated regulations to figure out, no expensive infrastructure to build, just build on top of SoFi's platform and start serving customers right away. Not to mention, this lets SoFi vertically integrate and not be dependent on other vendors. They plan to move from their existing vendors to a combination of Technisys and Galileo over the next 2 to 4 years, giving them huge cost savings and, more importantly, flexibility in launching new products and services. Another point on the strategy side, SoFi is using their technology platform as a way to expand into other countries that might have very different laws around, say, lending. They've recently pushed into markets outside the US with Galileo, launching in Latin America in 2020, opening an office in Mexico City, and certifying MasterCard's local Mexican domestic switch. Or with Technisys, opening them up to 11 new geographic opportunities in South America. So for the category of strategic impact, I'm going to say the technology platform has a hugely positive effect. It really is the core of SoFi's future strategic positioning. So now we've gone through SoFi's 3 areas that technology platform is having an impact: earnings, technical, and strategic. But what conclusion can we draw from this? Well, we know if SoFi can achieve their long-term goal and build the AWS of fintech, they will absolutely own the domestic fintech market, and maybe even the international one. We also know that they are investing extremely aggressively to make this a reality, pouring what many think is an irresponsible amount of money into acquisitions to help position them strategically for the future. But the question comes up of, can they afford this? While SPAC-induced hype shortly after the IPO via Chamath Palihapitiya gave SoFi some runway to finance their business off the back of their investors, many of those investors have fled the stock recently as money has flowed out of the fintech sector in general. If they can't find an alternative source of funding or a different way to build their tech platform, or see a miraculous recovery in their market cap, they will never last long enough to become the platform of their dreams. So I personally am holding SoFi stock, but I want everyone to know that this is now by far my highest risk position in my portfolio. It genuinely could be a moonshot or a falling star, and we'll just have to watch closely going forward to see which one it ends up being. To be very clear, SoFi is not my favorite stock. It's not even in my top 5, but I do own shares in the company because I see their potential. That doesn't mean we can ignore the risks in investing in such a volatile stock, but let's not get overly pessimistic either. And if you want to help out both SoFi and me personally, sign up for SoFi using the link in the description and get $15 in free stock. Don't forget to like and subscribe, and I'll see you next time.